Hello, and welcome to PubK's 2023 Government Contracts Annual Review. We're thrilled to have almost 4,000 people registering for this four-day event. This is the final session of this day 3. Tomorrow, we conclude with 2 additional blockbuster panels. We hope you'll be able to join us for both of the remaining sessions tomorrow, but a separate registration is required for each session that you want to attend. Registration is available on the PubK site under the Annual Review tab. My name is Alan Schwatkin. I'm the president of the PubK Group and a partner in the law firm Nichols Lew. I'll be your host, facilitator, and moderator for this year's annual review. The PubK Group publishes 4 newsletters: PubK Law, PubK Compliance, PubK Cyber, and our newest, launched in mid-2022 and relevant to this program, PubK M&A. Many of you are already subscribers to one or more of these publications, and we very much appreciate your support. Some of you joining this annual review are not yet subscribers, but I hope you'll consider becoming a subscriber. Information is at the website shown on the slide or is available from any of the contacts you have at the PubK Group. This conference would not have been possible without the strong support of our event sponsors, all of whom are listed on these next 2 slides. I encourage you to look at their skills and capabilities these firms have and engage them accordingly. Also new in 2022, PubK joined with Arnold & Porter to launch a periodic podcast called Bonafide Needs, covering emerging issues and interesting interviews. We'll continue that podcast in 2023 as well and encourage you to access them through our website. If you're interested in partnering with PubK on a website, on a podcast, we'd be pleased to discuss this opportunity with you. In lieu of speaker gifts and in honor of our sponsors, PubK is making a contribution to the Capital Area Food Bank. I hope you'll consider making an individual or an organizational contribution. Since the entire program is being held virtually, all attendees will be in listen-only mode. Your video will remain disabled throughout the session, but we welcome your questions. Use the Q&A box at the bottom of your screen. However, with so many attendees, it will not be possible to answer all of the questions in real time. We are capturing your questions and will endeavor to answer as many as possible after the conclusion of the annual review. All presentation slides for this session are now available on the PubK site. All of the presentation slides, along with the audios, will be available for download from the site probably within a week or so at the conclusion of the full annual review. We'll send an email when this information is available for download, how to access it, for how long the material will be available. We're also applying for CLE approval in Virginia, California, Texas, Florida, Colorado, and Kansas. We've already received Florida approval, but while we cannot guarantee approval in the other jurisdictions, we expect to have that acceptance within the next few weeks. Again, if you're interested in CLE, you have to notify us on the website, and we'll notify all attendees when those approvals have been received. So if you're interested in CLE, please look for our poll question during this presentation. The state boards require us to verify your participation. The poll's a simple question. We'll keep track of the responses. If you don't wish to obtain CLE, you can ignore the poll or just answer for fun. Now I'm thrilled to continue this 8th PubK annual review with our session 10 panel on M&A. Our distinguished panel members are Susan Gabe from Houlihan Lokey, Damian Specht from Morrison Forrester, and Todd Overman from Bass, Berry & Sims. Susan, over to you.
Thanks, Alan, and thank you for having me again this year. I've really enjoyed doing this over the last few years now. Just by way of background, my name is Susan Gabe. I am a managing director in the Aerospace Defense and Government Group here at Houlihan Lokey. By way of background, Houlihan Lokey is a New York Stock Exchange listed financial services firm that has been ranked #1 in terms of M&A transactions completed each of the last 5 years. Within the government technology and services practice, which I co-head, we've done about $4 billion of transactions over the last 2 or so years. Unlike Damian and Todd's presentations, my slides are a lot heavier on graphics and pictures, but hopefully they'll convey some insights into what we see going on in the M&A market. Specifically, I'll touch on public company valuation trends and growth trends, M&A volume and valuation trends, and then a little bit of what we're seeing in the private equity and capital raising market in this particular market space. So on the first slide, I'll start with public company stock performance and valuation trends. Obviously, the broader markets have been challenging for the last year or so, and virtually every sector across industries has had valuation compression, certainly starting off with large tech stocks. The government, technology, and services sector, on the other side of the coin, has seen resilience in stock price performance. If you look at what's happened within this sector relative to the broader market, there's been roughly a 40% disparity between the S&P and the large public companies in the government technology space. These are large companies like Leidos and CACI and Booz Allen. And I always start with public company trends because they provide a barometer and a backdrop for how these companies think about M&A, their interest level in M&A, how they value target companies. If you go to the next slide, we'll get into a little bit of valuation multiples, and the next two slides address what we're seeing there. From a big picture perspective, the government, technology, and services space really saw valuations peaked immediately prior to COVID. We had valuations that were in the kind of mid-teens, reaching 17 times EBITDA in February of 2020. Like every other sector, we did see some valuation decline in the ensuing 12 to 18 months. We're all well aware of the Vladimir Putin invasion of Ukraine. We saw valuations in the sector sort of bottom out around 11 times EBITDA. And given the backdrop of the threat environment, which the Ukraine situation has obviously exacerbated, we've had valuations expand pretty consistently over the course of the year and sit currently around 13 times EBITDA. So we have a threat environment that's obviously challenging, a lot of discussion around the near peer threat with Russia and China. And along with that, we've got continuation of a really favorable budget environment. If you look at the most recent omnibus spending bill, the proposed FY23 defense spending of about $860 billion is up 10% from last year. And then when you look at the non-defense side of discretionary spending, the proposed spending for FY23 is about $787 billion, up 8% from last year. Those are obviously some really healthy growth rates in terms of the overall spend. Next slide. Talk a little bit more about the historical context of public company valuations last year. And these are median multiples for each year going back more than 20 years now. The median public company valuation multiple in the space was about 13 times last year. You can see that that's pretty consistent with where things have been over the last 4 to 5 years, notwithstanding all of the turmoil in the broader market. We follow very closely revenue growth rates for these companies, and keep in perspective that the public companies today are 5 to 10 to approaching $15 billion companies. So growing 3 to 5% a year is a pretty healthy growth clip. But we saw revenue growth rates for companies in the space generally start declining when COVID hit for a whole host of reasons. We saw labor challenges, supply chain issues. The sector wasn't fully insulated from some of those issues and challenges that COVID brought. But since the end of 2021, we have seen the industry start to pivot back to a little bit more of a growth mode, with the median growth rate about 5% last year. From an organic perspective, we saw roughly 4% last year, 2% the prior year. So the companies in the sector are not only well capitalized from a balance sheet perspective, but they're performing really well operationally. Next slide, we'll get into a little bit more about what this all means for M&A. I don't think there were enough hyperbolic words to describe the M&A feeding frenzy, if you will, that we saw in this sector in 2021. And as you can see in this set of graphics, all sectors saw a pretty robust set of M&A activity in 2021 to 2022. If you look at aggregate volume, both within the GT&S sector and all sectors, volume was down roughly 40%. One might say, gosh, that's a significant decline, and on paper it is. We sort of look at 2022 as more of a normalization or a return to historical averages. If you look at our sector in particular, close to 100 deals in the government technology and services space that roughly matched the prior 3-year average. Interestingly enough, in the broader market space, $3.6 trillion of deals, again, this is across industry, sort of mirrored that trend. So in a lot of ways, 2022 was a bit of a year of normalization when it comes to M&A. Next slide. We'll talk a little bit about where the transaction activity within this sector was down in terms of who was buying and who was selling. If you look at the metrics on this slide, you can see that nowhere was the activity more pronounced than with private equity buyers. The number of new platforms purchased by PE firms in the space declined about 50% in 2022 relative to the prior year. Private equity exits in this space were down about 60% from the prior year. The strategic buyer activity was down too, but if you look at both the large public strategic buyers and the private equity platform buyers, those are PE funds that own an existing platform as a buyer. Transaction declines were much more modest. They were both down about 20%. So why was the transaction activity down? First, I would say it wasn't for lack of interest from the buyer community. If you look at what the public company executives are saying, most of them are still maintaining a pretty open aperture for M&A targets that meet their strategic criteria. Certainly PE funds have been impacted somewhat by the financing market volatility, but generally the financing markets within the GovCon space have been open and available to support deals in this market. And so a lot of the decline in activity and the constraint around volume has a lot more to do around the lack of supply of good quality candidates than it does the lack of interested parties who are interested in engaging in M&A. And if we go to the next slide, we'll talk a little bit more about private equity in the government contracting space. This has been one of the most fascinating stories to watch over the last 23 years that I've been doing this, which roughly corresponds to the timeline you see in this chart. The total number of PE platforms, notwithstanding some of the pullback in activity over the last year, has actually increased 20% since 2020. We've got more than 100 platforms in the space. There's a number of dedicated funds, such as the ones you see listed here, like Veritas and Carlyle and Arlington Capital, who have been prolific buyers in the space over the entirety of this timeline. But there's also a lot of newcomers within that 100. And I know Damien and Todd are going to talk a lot about the time they've spent over the last few years educating this universe of buyers on a lot of the nuances that go into doing deals in the space. So I think this has been and continues to be one of the most interesting stories in terms of investment activity in the GovCon space. If you go to the next slide, there's been a lot. The tough fundraising environment for private equity over the last year has been a significant topic of conversation. And notwithstanding what is generally viewed as a tougher fundraising environment, since 2021, 5 of some of the brand name PE investors in our space have raised more than $17 billion of fresh powder since the beginning of 2021. So as I sit here and think about the activity level and deal volume that we expect in coming years, this is a big reason why we continue to expect healthy deal activity in our space. As many of us know, PE firms are They're set up to spend the capital that they raise within a certain period of time. And so this certainly provides a favorable backdrop for continued strong activity in the space. Next slide. I think the last interesting trend that I'll note on buyers and investors in the space, which has been evolving over the last 12 to 24 months, there's recently been a lot more interest on the part of both large strategics, whether they're OEMs like L3Harris or Lockheed, some of the services companies like Booz, as well as VC investors in identifying what I'll call emerging technologies that are critical to national security and defense. And there's specialized PE funds like Razor's Edge, who are focused on this next frontier of emerging tech. So what does this all mean? Buyers are embracing different business models and have a footprint, and businesses that have a footprint across both government and commercial markets. Let me pause a second and catch my. Sorry about that. Last slide. And I say, what is potentially one of the more interesting slides for many last, and that is what has been happening with valuations. Valuations last year, despite what's going on in the broader markets, maintained a level of consistency in our space relative to prior years. Really well-positioned assets, particularly those with scale, continue to command strong valuations. You can see the scale premium here associated with more than platforms with more than 100 million or 500 million of scale. And I think this continues to support the scarcity value of some of these businesses that are successful transitioning out of what I would call the set-aside world into the mid-tier. And I know that Todd and Damien will spend some time talking a bit about sort of the set-aside dynamics in the context of M&A and how that impacts buyers' views of valuation. But there's always been an opportunity here to create a really valuable mid-tier business. And that's one of the reasons why PE has continued to have a lot of interest in this space. So with that, I'll pause and turn this over to Todd.
Thank you, Susan, and thanks so much for that fantastic overview. It really sets up the next portion of our presentation. Well, I'm Todd Overman. I'm chair of the government contracts practice at Bass, Berry & Sims here in Washington, D.C., and it's a real pleasure and honor to be part of this panel today. Damien and I are going to talk about, as Susan mentioned, there will be no graphics in the following 20 slides. We're lawyers, we don't really know how to do graphics, but we can put a bunch of words on the screen that you guys can read while we're talking. But we will be talking about several topics of interest when doing deals in this space. I'm going to talk a bit about joint venture due diligence, and Damien's going to talk about small business transfer issues. We're both going to talk a bit about rep and warranty insurance in the GovCon space. I'm going to talk briefly about novation and conversion best practices, and then we'll finish up with the all-important bidding post-acquisition questions. So let's just dive right in here and talk about some key areas when doing deals in the GovCon space. Right off the bat, many of you on this program probably are very familiar with SBA's Mentor Protege program. There's been a small business panel already during the annual review. But it does introduce a new layer of potential complexity in deals involving whether it be small businesses or mid-tier businesses. But this program was created back in 2016. It has obviously some benefits that proteges can get from mentors without affiliation concern. But the real benefit for the mentors is this opportunity to form joint ventures with the protege and go after small business set-aside contracts, wherein they can perform up to 60% of those small business contracts. As long as your joint venture is formed underneath the SBA Mentor Protege program and of course regulations, you are exempt from affiliation concerns, which leads us into an important diligence issue. Next slide, please. Since 2016, there are now over 1,600 active mentor-protege agreements. Now, there is no track or list of all of the joint ventures that have been formed under approved mentor-protege agreements. But I think based upon Damien and I's practice, as well as many of you on during the program, you know there's a lot of joint ventures out there bidding on and often winning work. So what are some key diligence issues, when you're looking at a JV that has either been formed or has won work under a small business set-aside contract? Obviously, first, some of this is shaped by, who is your client? Are you representing, the mentor or the buyer? Are you representing a protege, the small business? And how are you shaping, the issues around the joint venture agreement? But I think part of the diligence starts with understanding the sort of relationship or agreement that's in place between the parties. And SBA considers informal JVs, to be partnerships. Therefore, I advise clients to always form an LLC to avoid the liability issues associated with partnerships, as well as to avoid some of the offer war issues. If it is a former separate legal entity, it can't be populated, and the only employees you can have are for separate administrative functions. So again, checking these sorts of things as you're looking at potential joint venture as part of the deal. Next slide, please. There are a list of 12 required provisions that must be in the joint venture agreement. So when you are reviewing that joint venture agreement, hopefully it's in the data room, you really want to look at it almost as if you're looking at it in a size protest context. You can take the list of regulations, you can match it up with the joint venture agreement itself. And if you've gone to a great law firm for that operating agreement, there might be a chart at the front that matches up the provisions in the operating agreement to the regulatory provisions. That not only can help the negotiation process, but if you're ever challenged, it of course can help the review by an area office or potentially OHA. So you're looking at, next slide, please. You're looking at these various required provisions that are in the regulations, including the itemization of major equipment, which we know has been a point of contention as to how you do that and doing that for each contract, as well as obligating all parties of the JV to ensure performance. The other thing you might also be looking at as you're looking at these provisions is what has the joint venture put in place, particularly if it has been awarded a contract in terms of its subcontracts with its members. Because obviously in an unpopulated joint venture, you're going to have to utilize the members for performance, and you often need to document that subcontract to those members. Similarly, if the JV has utilizing the third parties, how they documented that work, to a third party. Next slide, please. When you're reviewing that joint venture agreement, you need to be aware of, the unwritten rules around negative control. Those of us are familiar with SBA's affiliation regulations, negative controls, where a minority owner can block certain day-to-day activities of the concern. They're either through, blocking the former board of directors and blocking their day-to-day business functions, or requiring a supermajority to take certain ordinary actions like incurring debt, payment of dividends, entering into contracts, and so forth. Those are going to be things that might have slipped into a joint venture agreement that has either won or is trying to win a small business set-aside contract. There are some special rules for available veteran-owned small businesses, and we've included a case here that talks about some of those unique requirements. Next slide, please. The other thing when you're looking at, I mentioned this before, the joint venture agreement can't just be fulfilling the regulations or ticking off the 12 requirements. The JV agreement must also be contract specific. That is, it must address what it is that the JV is intending to do, what the parties are bringing to the table in terms of not only their responsibilities, but equipment and services they're going to provide. And you need to be, you hopefully will see that the joint venture agreement has been amended prior to submitting an offer to definitize that what it is that, or to itemize what it is that each member of the joint venture is bringing to the table. Next slide, please. So outside of the joint venture agreement, you also need to make sure that you are remembering the performance of work requirements that are required underneath these regulations. As I mentioned at the beginning, the mentor protege must comply with limitations on subcontracting. That is, it must perform 50% or more of the work or cost of the contract, and it must meet the 60-40 performance of work requirements. That is, the mentor can perform up to 60% of the contract. Now, depending on the type of contract, the mentor protege cannot pay more than 51% of the amount paid by the government to its firms that are not similarly situated. So again, looking at if they have third parties that are involved in the performance of the small business contract, you need to make sure that they are complying with and adding up correctly what it is that the protege itself is performing. Also important, and you may see this in the joint venture agreements that you are reviewing, there are particular annual reports that have to be provided to the SBA and COs on the performance of work requirements. And obviously you're going to need to see some records in terms of how it is that the joint venture has not only made those reports, but also has been able to comply with the performance of work requirements. So with that, let me turn it over to Damien to talk through some small business transfer issues.
Yes, and before Damien begins, I want to let all the attendees know we are running our CLE poll. Please answer this poll if you would like CLE credit. The poll will be up for 2 minutes. Thank you.
All right, thanks, Craig. Can we go to the next slide? Excellent, thank you. So this is Damien Speck from Morrison Forster, government contracts partner, and do quite a few transactions in this space. And as all of you know, most of those involve small business transfer issues. And so we wanted to talk a little bit about small business transfer, and not all the small business rules that were covered in the prior panel, but just sort of where this fits into the kind of work that we do. Government-wide goal is 23%. The federal government actually exceeded that in 2021. Used to be a hobby horse for a bunch of us that we never ever hit the goals. Well, they keep hitting the goals now. So 27.2% shows you that a huge chunk of federal dollars are going to current small businesses, and there is political pressure to increase the amount of work going to small businesses and specific subsets of small businesses, including small disadvantaged businesses and the like. So this is going to be part of the M&A portion of this practice for the foreseeable future. Next slide. All right. So when we're looking at small business issues, the first thing that we start off with is super simple. Is the target actually a small business concern? Seems easy, but those of you who practice in this space know that people get very confused about these issues. They get very confused about what NAICS code they're under, whether they're under an exception or not, whether they're under the revenue standards, the employee standards. So have to make sure they're actually doing this correctly. So first, what is their NAICS code, right? Each code has a relevant small business size standard. And it's either for employees standards measured over 24 months or for revenue standards measured over 5 years. And so first, get their taxes, actually do the math, figure out what standard that they actually meet and whether that lines up with their contracts. Oftentimes, businesses will not consider their affiliates. Sometimes that's a really peculiar case where they're owned by a large business and they just had no idea that they had to affiliate themselves with the large business. Sometimes it's a private equity structure, but sometimes it's just an individual who owns different business concerns. And sometimes what we'll hear on this point is, oh, well, those business concerns aren't government contractors. I've got a restaurant and I've got a mechanics shop, and those shouldn't be affiliated. Well, it all comes in if they're owned and controlled by the same individuals. So we always look for related concerns, affiliated concerns, et cetera. And of course, the standard is that affiliation exists when one entity has the power to control the other, whether or not that power is actually executed, right? Whether or not they actually do anything about it. So those private equity firms or those investors out there that say, oh, I'm a passive investor, that's not a very powerful argument, and it's not something that we usually give credence to. Next slide. And then the big one. So now you've determined that they are or they aren't a small business. And if they are, will they lose that status as a result of the acquisition? So you have to take into account affiliates, and now your buyer of that business will be an affiliate. So you have to do the math and figure out whether or not, when you include everything together, they'll actually be an affiliate. We have this conversation with private equity firms all the time, and my practice, and I think Todd's as well, is to essentially consider that any entity that is owned or controlled by the private equity group, whether it's fund 1, 2, 3, 4, or 5, it continues to be affiliated with the given entity, unless there are some peculiar facts out there. So you have to figure out the factual matter of, will they actually lose their status as a result of the acquisition? And so that requires a little bit of self-diligence of your client, as well as the diligence on the prior slide related to the entity itself. Next slide. Okay. So now you figured out that they are a small business. You figured out that your client isn't a small business. So how will the loss of target small business status affect its future business? And I think, here, I don't know, Susan, if you want to weigh in here before I get into the substance of it, do you think that there's been a change in recent years as to how buyers view small business content and view transferability, or has it been sort of about the same?
I think what I've seen, Damien, is buyers having more openness to having to explore a small business target and a transition plan and be more open-minded about the situation than they maybe previously wanted to be. In large part because, as you showed on your prior slide, there's more dollars going to small businesses. Even some of these more sizable targets that have a few $100 million in revenue still sometimes have small business issues. And because there is a scarcity of some of these sizable mid-sized assets, buyers have to embrace it. They have to think about whether there's a transition strategy that works, and they have to roll up their sleeves and figure it out. And as you know, there's no one size fits all answer to whether the work will transition and how long it will transition for. So we've seen buyers be much more amenable to embracing it.
That's great. And maybe that a little bit of that is sort of lived experience that when you and I started doing this, people thought that small business contracts would explode the second you touched them. And I think, and maybe that's changed over time.
Yeah, I think it has. And that's not to say there's not a valuation implication in some cases, right? But I think if you want to be a buyer in this space, you have to be smart about how you diligence the story, how you value it. And ultimately, if you want to be a buyer, you have to be able to get your arms around this.
Totally agree. So let's talk about how the rules actually work. And it's true that many buyers are scared off by small business work because they think that all small business work is going to go away the second that they close the transaction. So what's the actual rule, right? The actual rule is that business is not going to be able to bid for new standalone contracts that are prime contracts that are small business set-asides. That's fine. And as Susan said, you're going to need a transition plan to figure out what you're going to do with that. Are those going to be bid through a JV? Are you going to flip to being a sub? How are you going to capture that value for standalone incumbent work? For task orders, it's often a different story. In many instances, on small business set-aside IDIQ contracts, for example, there is continued eligibility to be able to bid on future task orders. That's really specific to IDIQs, and under SBA's new rules, there's new analysis there, but essentially under IDIQs, it's much more bespoke. And then you have this new issue of whether or not you can keep pending proposals under the new rules. And it used to be that you had to recertify a pending proposal, but you knew that as long as that proposal had gone in and you were small at the time it went in, that proposal was awardable. And SBA's 180-day rule changed that presumption. So now if the proposal has been submitted fewer than 180 days, that actually becomes unawardable as a result of a change in size status. And so we are absolutely seeing transactions that are timed to that, where entities are not putting themselves on the market until their major proposals are at least 180 days in, so that they don't lose those. But it's important to emphasize that business will not lose its small business contracts just because it's been acquired, unless they're 8A contracts, which is a slightly different analysis. Customers will no longer be able to claim small business credit, but as the prior slide showed, there are a number of agencies that are meeting their small business goals. So that goaling may not be quite as important as mission to those particular customers. Another thing people sometimes miss is when you're thinking about small business transition, the company can also be subject to new requirements because it's no longer small. And specifically, if it had a cost accounting standards exemption as a small business, it may now hit a triggering contract. And also, it may be required to adopt a small business subcontracting plan that'll eat into its work share. So important issues that aren't necessarily related to whether they get to keep the contracts, but relate to the profitability of those contracts. Next slide. All right, RWI. And so, I mean, I think before Todd and I get into this, Susan, I guess I've seen bankers describe RWI as sort of table stakes for competitive transactions. You want to address that before we get into the nitty gritty?
Yeah, I think it's more than just table stakes. I think I can't tell you the last time I worked on a deal that didn't have it, Damien. I think for a little while, it seemed like the private equity universe was more bought into using RWI than strategics, but I think the strategics have caught up. So I think you sort of have to do it to be competitive. And I think there's a general comfort level that the product's available. It's worth doing. I've heard lots of people say over the years that it should make the purchase agreements a lot easier to negotiate. I'm not sure that I've observed that yet, but would love your thoughts on that. But I think it's pretty much the norm at this point to use it.
Yeah.
Susan, how often are you seeing the premium payment split?
It depends on the competitiveness of the situation. If it's a really competitive situation, I think the buyer will pick it up. I think it's probably at least, 50% of the time, I think it's split 50% or more.
Yeah. Right.
Yeah.
Well, we jump right past, what is it? But I think folks have probably read through this slide by now. Thanks for those inputs. Let's jump to the next slide, given the time. How does it impact my deal? What I've experienced, particularly from the buyer side, is that I've said it's brought back the diligence memo, and it's brought back the importance of the diligence memo. And that is because, oftentimes you might have done deals prior to RWI where, a long email summary of diligence issues might work, but, the underwriters now require a fulsome memo because they're in effect doing their own kicking of the tires of the transaction. And so from, those involved in a deal, whether it be lawyers or consultants, you've got the diligence memo coming back. From the seller side, you've got to be prepared to answer, multiple rounds of questions, maybe even a little bit more questions than you might have before, because you've also got, underwriters taking a peek at it. I don't know, David, anything else from you on that?
Yeah, no, I think that's all correct. And I do think it has changed the way that we do deals. And I think before RWI, I'd probably written like 2 diligence memos in my life. So there you go.
Next slide, please. So we tried to summarize here, just kind of at a high level, some of the buyer benefits and also some of the seller benefits. To answer, or address Susan's question, does it make the rep and warranty negotiation, the purchase agreement negotiation go a little smoother? I think actually it does. I think particularly on the reps and warranties, given the nature of the target and how much of the business is flowing through the target, the GovCon rep is an important rep. And if we're having rep and warranty insurance as a buyer, I can say, hey, look, I need a strong rep. You may, want to schedule some things against it, but, I'm entitled to a strong rep. We're paying for some of that protection. So I do think it has, we're still going to have, I'm sure, a couple rounds of negotiation, but I do think it has, when rep and warranty insurance is available, it has made that process a little easier. What about you, Damian?
Yeah, I think that's right. And I think thinking about it from a seller's perspective, you can give more coverage because of that risk allocation over the sort of the unknown. You still have to have a good faith belief that everything you're repping to is true, right? And you don't want to fall into some sort of a fraud category, et cetera. But I do think that it makes sellers more willing to give them sort of the broad reps. But as I say, when you're representing sellers, you can't just rubber stamp the reps. You do have to walk the sellers through each and every one of them and make sure they're actually true, because you don't want to end up in some fraud fight later on.
Next slide, please. So the last point we want to make is that, rep and warranty insurance is not a save-all. You are going to have underwriters take certain exclusions from the coverage that they're providing. And those are included a list here, but I think some of these are fairly self-explanatory. I think we are still seeing a little bit of the PPP and CARES Act. I'm seeing that, less and less as those things get resolved. You're going to have, there's, given the nature of the business, particular cost issues or DC audit or open audit issues, could be a contract exclusion. And then, of course, the all-important cyber and, where the company's at, what's its history on data breaches or even potentially self-reporting. Those are sorts of things you can see in exclusions. I don't know, Dan, anything else you want to add to that?
And I think these will really vary by vendor. It used to be in the very early days of RWI, they excluded all government contracts because they didn't understand it. And now I think it is narrowed down. But I think these will vary by vendor, and some of them will sort of have set views on a few of these. Even if your transaction doesn't even implicate it, they'll exclude it. So
great. All right, next slide, please. We're going to move to our fourth topic, taking a quick look at conversion and novation issues. If you've been involved in a novation process, the rules are actually fairly straightforward. They're set forth in subpart 42.12. DCMA it gets involved in larger novation packages, and there's a fairly straightforward process that's fairly consistent across agencies. Now, with the advent of so much more private equity investment and the desire for step up in tax basis, you've seen a lot of requirements for the contractor or the offeror to go through a conversion from an Inc. to an LLC prior to closing the deal. And so that of course, that conversion isn't addressed anywhere in the FAR and can lead to some confusion with the government. So next slide, please. So real quick, the basics, novation is required for an asset transfer or corporate consolidation or merger, effectively where the contractor goes away. The FAR talks about it's not required for a stock purchase when these certain conditions are in place. And, we love it, but the novation occurs post-closing. I'm trying to explain that to a new buyer in this space who wants to do an asset deal is always extremely difficult and confusing for them to understand. Why won't the government approve it at closing? Just because they won't. The next slide, please. So what do you do while you're waiting for that novation? So the selling entity is still the prime contractor, so it has to continue to exist and invoice the government for the work. But the parties have to decide, who will perform and how. And the most common way to do that is a subcontract pending novation. And those effectively protect both sides to make sure that the buyer gets the benefit of the work and the seller makes sure that somebody's actually doing the work. Now, if you're transferring contracts that have a consent to subcontract, don't forget that issue, as well as don't forget performance of work requirements and cost accounting concerns. The novation requirements are pretty straightforward to set forth in the FAR. Some of the big hiccups that we see when submitting an novation package post-closing are this audited balance sheet requirement. It's never really feasible. There's different ways to get around that. My favorite is a certificate from the CFO, testing the accuracy of the financials. You also have to be really careful about when you have to give original signatures. There used to be some kind of COVID passes on that, but those are going away. So more and more agencies are requesting original signatures, not only on the innovation agreement itself, but also on some of the underlying documents. So got to prepare your clients that this is not a quick and easy and dirty process. It may take some time. In fact, it may even take answering some questions and submitting some new documents. Lastly, the last slide here in this section, conversions. As I said, LLC conversions are becoming more common. There's nothing in them about the FAR, but what's critical from your advice perspective is that if they're going to do a conversion, the corporate guys want to do a conversion, make sure you're doing it under state law, where in essence, it's the same, the state statute says that it's the same entity before and after the conversion. That's important because it'll maintain our critical numbers that we care about in the GovCon world, our cage code, our TIN and our identifier number. And you want that to be certain that you've got the statutory support for that. So basically the name is changing from an Inc. to an LLC, and sometimes the name itself may change. But you really want to treat it and try to treat it as a change of name, because there really is nothing to novate or to assign. So you want to treat it as a change of name agreement and see if the contract officer will approve that. DCNA has even developed a conversion agreement document that if you need to, you can fall back on for purposes of getting that conversion approved as effectively a name change, which of course you need to do in order to update SAM. So with that, I will turn it back to Damien to talk about our last topic.
Excellent. All right. Thanks, Todd. All right. So you have done your diligence. You've bought the business. Congratulations. Now you need to bid out of it. And this gets complicated. And there are a lot of misnomers and misunderstandings about how it is that you bid post-acquisition. And there's actually been a good deal of litigation recently about affiliates and all the rest. So here's what we tell folks who are the buyers in these situations. Yes, I understand you want to leverage the capabilities of affiliates. The key is clarity as to the offeror, the name, the unique ID, the cage code. Those are all things that need to be crystal clear as to who that offeror is. And that's particularly true on IDIQ contracts and the like. The offeror is the legal entity that is submitting the bid, and that's whose full legal name, whose cage code, and whose unique entity identifier should be on that proposal. If you then want to go on and you want to rename the business, you want to include it in a group of companies, et cetera, you can do that. But you have to establish first clarity as to the offeror. If you confuse the government, you put yourself at significant risk, not only of protest, but frankly of being unawardable and thrown out because the government can't figure out who it is that they're talking to. And as I say, the risk here is particularly high when you're talking about an IDIQ contract or a federal supply contract. And we get the question all the time. No, you cannot bid through your affiliates' IDIQs, your affiliates' FSS. It has to be the actual offeror bidding there. They can have affiliate agreements with you to do that, but unless you're going to novate that contract from one entity to another, you've got to actually include the actual name of the actual entity that holds the overarching contract. And then affiliates are not the offeror, right? Next slide. When you're going to use affiliate past performance, you've got to emphasize meaningful involvement. And what meaningful involvement is sort of in the eye of the beholder. But what we know is it's something more than ownership, something more than reach back. And it's something along the lines of, is there involvement of the workforce, of management, of facilities? What is that affiliate going to be doing? Sort of the gold standard is to identify the specific folks from that affiliate that are going to be working on the contract, the specific capabilities that they're going to bring to bear, to include a letter of commitment or a teaming agreement, or sometimes even a subcontract or intercompany agreement with that affiliate. That's sort of the gold standard. Probably not necessary in all instances, but the gold standard. The more specific you are, the better, and the more likely you are to capture that past performance and those capabilities that you're looking for. Keep in mind, though, that different solicitations, particularly the math-based ones, OASIS, CIOSP4, et cetera, may have very specific rules about how affiliates are considered, and so that would override the larger general rules that we were just talking about. Next slide. So I want to give you an example of this. This is an older protest, IAP World Services. The agency awarded a contract to a joint venture and one of its members, and there was a favorable past performance reference for 2 of that member's affiliates. Next slide. There was no dispute that those affiliates were owned by the JV member. The problem is that the proposal didn't describe actually how they'd been involved. It just said that there would be corporate reach back and that they were affiliates. And the GAO stepped in and sustained the protest over the agency's objection and interpretation, saying that it's inappropriate to consider an affiliate's record where that record does not bear on the likelihood of successful performance by the offeror. So the agency clearly gets some discretion, but not that much. And that particular error endangered a $66 million contract. I think next slide, or is that maybe our last one? There you go. I'll hand it off to you, Alan.
Oh, perfect timing. And Damian, thank you. Susan, Damian, Todd, what a great program. Everything you wanted to know about M&A, from the market all the way through the transaction, well covered in this slide. And thank you very much for the participation in the presentation. Let me also thank our event sponsors for their support. Their names are on this slide and the next slide. We couldn't have done this program without them. I thank you for joining us today and enjoy the rest of the afternoon.